You ever feel like you're trying to decode a secret language when you read the financial news?
hmm
Headlines are screaming about inflation or interest rates, but what do these terms really mean for you, and your money?
Yeah,
That's exactly what we're tackling today, a deep dive into the essential economic terms that traders and investors really need to know.
right.
Think of this as your cheat sheet to understanding the forces shaping the financial world.
That's right. And it's not just about memorizing definitions, is it?
Mm-hmm.
Our goal, inspired by a really comprehensive article from Miss Nancy, is to truly understand the significance behind these terms,
Mm-hmm.
how they connect and what they signal about the broader economy.
And Miss Nancy didn't hold back. We're looking at around 50 key
It's
terms.
quite a list.
It is. Now, that might sound like a mountain of information, but don't worry. We're going to break it down, explore the connections, and focus on why these concepts are actually, well, crucial for making sense of the markets. Okay, let's unpack this by starting with the big picture, the indicators that give us a sense of the overall health of an economy. First up, gross domestic product, or GDP.
Right, GDP. It's often cited as the primary parameter of a country's economic activity.
Okay.
It represents the total monetary or market value of all the finished goods and services produced within a country's borders in a specific period. So sustained GDP growth generally points to an expanding economy.
So higher GDP, better economy, basically.
Generally, yes.
Right.
But what's fascinating here is that while GDP tells us the size of the pie, it doesn't necessarily tell us how that pie is being distributed or, the environmental costs of that production, things
Right.
like that.
That's a really important point. So while we often see GDP growth as just, universally positive, it's worth remembering it's a broad measure. It has limitations.
Absolutely.
Now, when that growth engine starts to sputter and GDP actually declines for 2 consecutive quarters,
Okay.
that's when we enter a recession, right?
Exactly. That's the technical definition.
Mm.
And it's more than just a statistic. It signifies a pretty widespread contraction in economic activity.
And you feel it.
Oh, definitely. A recession can have tangible effects like rising unemployment as businesses cut back,
Yeah.
decreased consumer spending as people tighten their belts,
Mm.
and often a downturn in the stock market. But the economy isn't static. It naturally goes through phases of expansion and contraction, which leads us to the concept of the business cycle.
Okay, the business cycle. Think of it as a recurring pattern, like seasons.
Sort of, yeah. With
Yeah.
four main stages: expansion, peak, contraction, or recession, and then the trough, the bottom.
Mm-hmm.
Recognizing where the economy might be in this cycle can offer insights for investment decisions.
Although, predicting the exact timing of those turning points is, well, notoriously difficult.
Extremely difficult, maybe impossible.
Right. Okay, let's talk about something that directly impacts the purchasing power of our money: inflation.
Inflation. At its core, it's the rate at which the general level of prices for goods and services is rising.
So things get more expensive.
Exactly. And consequently, the purchasing power of your currency is falling. Now, a little bit of inflation is often considered healthy for an economy,
Okay.
but high or, runaway inflation
Mm-hmm.
can really erode the value of savings and investments.
And it's important to know why it's happening, isn't it?
Absolutely. What's crucial to understand is the why behind the inflation. Is it because demand is way up? Is supply limited? Are production costs rising?
Right.
The answers to those questions have different implications for policy and for investors.
And how do we actually measure this rise in prices? That's where the Consumer Price Index, or CPI, comes in.
Yes, the CPI. It tracks the average change over time in the prices paid by urban consumers for a basket of consumer goods and services.
A basket, like groceries and...
Groceries, housing, transportation,
Yeah.
medical care, a whole range. It's a key indicator of inflation's impact on households.
Mm-hmm.
But it's important to remember that the basket of goods and services used to calculate CPI might not perfectly reflect the spending patterns of every single person.
That makes sense. What I spend my money on might be different from, say, what you spend yours on.
Precisely.
Now, a related measure is the Producer Price Index, or PPI. How does that differ?
Okay, so the PPI measures the average changes in the selling prices received by domestic producers for their output.
Ah, from the business side.
Exactly. It looks at inflation from the perspective of businesses. And what's fascinating here is that changes in PPI can often foreshadow changes in CPI.
How so?
Well, if producers are facing higher input costs, raw materials, energy, wages, they're likely to eventually pass those costs on to consumers in the form of higher prices.
So PPI can be kind of an early warning sign for where consumer prices might be heading.
It can be, yes. Another critical indicator of economic health is the unemployment rate. What does this tell us?
Well, it's the percentage of people without jobs, right,
Right.
who are looking.
That's the key part, actively seeking work. It represents the percentage of the total labor force that is unemployed but actively looking. A higher employment rate generally signals a weak labor market, which can lead to lower consumer spending and slower economic growth.
Makes sense.
However, a very, very low unemployment rate can sometimes lead to concerns about wage inflation as employers compete for workers.
It's a delicate balance, it seems.
It really is.
And it's not just about having a job, but also how secure people feel in their financial situation. That brings us to consumer confidence.
Right. Consumer confidence surveys gauge how optimistic or pessimistic consumers are about the current and future state of the economy, and crucially, their own personal finances.
So it's about the mood.
It's very much about the mood. High consumer confidence often translates into increased willingness to spend, which can fuel economic growth.
And low confidence.
Conversely, low confidence can lead to a pullback in spending and potentially contribute to an economic slowdown. It can be like a self-fulfilling prophecy to some extent.
Interesting. Okay, finally, in our overview of the big picture, we have the balance of payments. This one sounds quite broad.
It is broad. The balance of payments, or BOP, is a systematic record of all economic transactions between a country and the rest of the world over a specific period.
All transactions, like trade.
Yes, trade in goods and services, but also financial flows like investments moving in and out of the country.
Okay.
Analyzing the BOP can provide insights into a country's economic health and its relationship with the global economy. A persistent imbalance, like a large current account deficit, for example, can raise questions about long-term sustainability.
Right. Got it. Okay, now that we have a sense of the overall economic landscape, let's look at the key players who try to, well, influence it. Central banks and governments. And the first term that comes to mind is interest rates.
Absolutely fundamental. Interest rates are essentially the cost of borrowing money.
But there's so much more than that, aren't they?
Oh, yes. Central banks, like the U.S. Federal Reserve, use key interest rates as a primary tool to manage inflation and stimulate or cool down economic activity.
So lower rates encourage borrowing.
Generally, yes. Lower interest rates encourage borrowing and investment, spurring activity. Higher rates tend to do the opposite. They make borrowing more expensive, aiming to slow things down, perhaps to curb inflation.
Okay. And a particularly important interest rate to understand, especially in the U.S., is the federal funds rate.
That's the big one the Fed targets. It's a target rate that the Federal Reserve wants banks to charge each other for the overnight lending of reserves.
Okay, so it's bank to bank.
Correct. While individuals like you and me don't directly access this rate, it acts as a benchmark. It influences other interest rates throughout the economy, from credit cards to mortgages to business loans.
How does the Fed control it?
They use tools like open market operations, basically, buying and selling government securities to add or remove reserves from the banking system, nudging that overnight rate towards their target.
Gotcha. So the federal funds rate is a key lever that the Fed uses as part of its broader monetary policy. Let's unpack that term.
Yeah.
Monetary policy.
Monetary policy refers to the actions undertaken by a central bank like the Fed, the European Central Bank, Bank of England, to manipulate the money supply and credit conditions.
Why?
To stimulate or restrain economic activity. Think of it as fine-tuning the economy by influencing the availability and cost of money.
And it's not just interest rates.
No. Besides adjusting interest rates, central banks can also use tools like reserve requirements, how much cash banks must hold, or, as we saw quite dramatically after the 2008 crisis, quantitative easing, or QE.
QE, that was a huge deal. Remind us how that works again.
Right. Quantitative easing involves a central bank purchasing long-term assets, typically government bonds, from commercial banks.
Injecting cash.
Exactly. It injects liquidity, or cash, into the banking system with the aim of lowering long-term interest rates and encouraging lending and investment, especially when short-term interest rates are already near zero.
Did it work?
Well, the effectiveness and, perhaps more importantly, the potential long-term consequences of QE are still very much debated among economists. It's complex.
Interesting. Okay, so the central bank focuses on monetary policy, and then we have government using fiscal policy. What's the difference there?
Fiscal policy involves the use of government spending and taxation to influence the economy.
So this is Congress or Parliament deciding things.
Precisely. Decisions about infrastructure projects, tax cuts, changes to social welfare programs, those are all examples of fiscal policy.
Mm.
Unlike monetary policy, which is typically controlled by an independent central bank, fiscal policy is determined by the elected government.
And they both affect the economy.
Yes, but in different ways and often with different time lags.
Hmm.
Both have their strengths and weaknesses in terms of their impact and how quickly they can be implemented.
Okay, that makes sense. Now that we understand the broad economic forces and the levers being pulled by central banks and governments, let's dive into the language of the markets themselves.
All right.
First up, bull market. That sounds positive. What characterizes it?
A bull market is generally a good thing for investors, yes. It's a sustained period of rising stock prices. It's typically accompanied by investor optimism, strong economic data, and often increased trading volume. It reflects a belief that the economy will continue to grow.
But. There's always a but.
There usually is. It's important to remember that bull markets don't last forever, and they can sometimes be fueled by excessive speculation, creating bubbles.
Right. And the inevitable opposite is a bear market.
Correct. A bear market is a prolonged period of declining stock prices. The common definition is a drop of 20% or more from a recent peak.
And that's linked to.
It's typically associated with economic downturns, negative investor sentiment, and increased selling pressure as investors become more risk-averse.
Sounds gloomy.
It can feel that way.
Eh.
But historically, bear markets have often presented opportunities for long-term investors to buy quality assets at lower prices if they have the stomach for it.
Good point. Now, sometimes we see a sharp drop that isn't quite a full-blown bear market. What's that called?
It's often referred to as a market correction.
A correct.
Yes. It's usually a shorter, sharper decline in the market, typically ranging from 10% up to, but not quite reaching 20%. It's often seen as a kind of recalibration of valuations after a period of strong gains.
So maybe the market got a bit ahead of itself.
That's often the thinking. Market corrections can be unsettling for sure, but they're also a pretty normal part of the market cycle.
Okay, so a correction is like a temporary breather or a reset before the potential continuation of the longer-term trend.
Yes.
And what drives these shifts in the market, these bull and bear phases, these corrections?
A key factor is market sentiment.
Sentiment, like feelings.
Pretty much, yeah. It's the overall attitude or feeling of investors towards a particular market or asset. It can range from bullish optimistic, expecting prices to rise, to bearish pessimistic, expecting prices to fall. And sentiment can be influenced by a huge range of factors. News headlines, economic data releases, geopolitical events, even just psychological biases. Fear and greed play a big role.
So it's almost like the collective mood of the market can become a self-fulfilling prophecy to some extent.
It certainly can feel that way sometimes.
Now let's talk about how much prices tend to fluctuate. That's volatility, right?
Exactly. Volatility refers to the degree of price fluctuations, the ups and downs in a security or market over a period of time.
High volatility means bigger swings.
Yes. High volatility generally indicates greater uncertainty and can present both opportunities for profit if you time it right, but also increased risk of loss.
Yeah.
Understanding the factors driving volatility is crucial for managing risk.
Definitely. And for markets to function smoothly, you need liquidity. What does that mean in the context of trading?
Liquidity refers to the ease with which an asset like a stock or bond can be bought or sold without significantly affecting its price.
So you can get in and out easily.
That's the idea. In a liquid market, there are always plenty of willing buyers and sellers, allowing for quick and efficient transactions at stable prices. Low liquidity, on the other hand, can make it difficult to execute large trades without causing significant price movements. It's harder to sell if there aren't many buyers around.
Got it. Finally, when we talk about the overall size of a company in the market, we often use the term market capitalization. How is that calculated?
Market capitalization, or market cap, is pretty straightforward. It's the total market value of a company's outstanding shares of stock.
How do you find that number?
You just calculate it by multiplying the current stock price by the total number of shares outstanding.
Okay.
Market cap is often used to categorize companies by size. You hear about small cap, mid cap, and large cap companies.
And they have different characteristics.
Yes, generally different risk and growth characteristics. Large caps are often more stable. Small caps potentially have more growth potential, but also more risk.
Okay, now let's move on to evaluating specific investments. We're going to look at some key financial ratios and metrics, starting with the price-to-earnings ratio, or PE ratio.
The PE ratio. You hear this one all the time.
Constantly. How do investors actually use it to assess a stock? Is a high PE good or bad?
Well, it depends. The PE ratio is a valuation metric that compares a company's stock price to its earnings per share, EPS.
Okay.
It essentially tells you how much investors are willing to pay for each dollar of that company's earnings.
So a high number means it's expensive.
It might suggest that a stock is overvalued relative to its current earnings, or it could indicate that investors have really high growth expectations for the future.
Uh,
Conversely, a low PE ratio might suggest undervaluation, or it could mean the company has lower growth prospects. The key is context.
Context like.
It's most useful when comparing companies within the same industry because the different sectors have different typical PE levels, or when looking at a company's historical PE ratio.
Got it. And you mentioned earnings per share, EPS. Let's define that.
EPS seems straightforward. It's simply the portion of a company's profit allocated to each outstanding share of common stock.
Exactly. It's a key measure of a company's profitability on a per-share basis.
Mm.
Investors often track EPS growth over time to see how the company's doing.
Makes sense. Now, besides earnings growth, some investors also look for direct income from their investments.
Dividends.
Right. And that's where dividend yield comes in.
So if a company pays a dividend, the dividend yield tells you the annual dividend payment as a percentage of the current stock price.
Precisely.
It's like the annual cash return you get just for holding the stock, separate from any price changes.
Exactly. Companies that pay regular, reliable dividends can be very attractive to income-seeking investors.
Yeah?
And the dividend yield provides a standardized way to compare the income generated by different stocks.
Okay. Now, beyond just the flow of earnings and dividends, investors also consider the underlying value of a company, its assets. And that leads us to book value.
Book value, isn't that essentially the net asset value of a company? Like, what would be left if it sold everything and paid off all its debts?
That's a good conceptual way to think about it, yes. Book value is calculated as a company's total assets minus its total liabilities based on its accounting records.
Mm-hmm.
It represents the accounting value of the equity held by shareholders. Comparing a company's market capitalization, its market value, to its book value can provide insights. How so?
Well, it shows whether the market is valuing the company above or below its stated net asset value on the books. But it's important to consider that book value may not always reflect the true market value of assets, especially intangible ones like brand names or patents.
Right, accounting value isn't always market reality. Now, another crucial aspect of a company's financial health is its debt load, which brings us to the debt-to-equity ratio.
Okay, so this ratio essentially shows the proportion of a company's financing that comes from debt versus equity, borrowed money versus owner's money.
Exactly.
And a high ratio might suggest a higher level of financial risk.
It generally does. The debt-to-equity ratio is calculated by dividing a company's total debt by its shareholders' equity. A higher ratio indicates that the company is using more debt, more leverage, to finance its assets.
And leverage cuts both ways.
It absolutely does. It can amplify returns in good times, but it also significantly increases the risk of financial distress or even bankruptcy in downturns if the company can't service that debt.
Okay, now let's shift our focus slightly and talk about bonds. Investors in bonds are primarily interested in the return they'll receive, and that's the bond yield.
So the bond yield is the total return an investor can expect to receive from holding a bond until it matures, taking into account its interest payments, the coupon, and any difference between its purchase price and its face value.
That's it.
And it's inversely related to the bond's price. When prices go up, yields go down.
Precisely. That's a key relationship to understand. Bond yields are also heavily influenced by prevailing interest rates set by the central bank and, importantly, the perceived creditworthiness of the issuer, how likely they are to pay you back.
Okay, speaking of creditworthiness, before investing in bonds, it's crucial to assess the borrower's ability to repay their debt. That's where credit ratings come in, right?
Yes, credit ratings are like a grade assigned to borrowers, companies, or governments issuing bonds indicating their likelihood of default.
Higher ratings mean lower perceived risk, like AAA is safer than B.
Exactly. Credit rating agencies like Standard & Poor's, Moody's, Fitch assess the creditworthiness. Higher ratings generally indicate a lower risk of default.
Default meaning?
Default is the failure to make timely interest payments or repay the principal amount when it's due. This brings us directly to the concept of default risk itself.
So default risk is simply the probability that a borrower will be unable to meet their debt obligations.
That's the core idea, yes.
And higher default risk typically translates to lower bond prices and potentially negative impacts on the borrower's stock price as well.
Precisely. Investors demand a higher yield, more return, to compensate for taking on higher default risk. More risk should mean potentially more reward. Okay, now let's get back to stocks for a moment and think about how individual stocks tend to move in relation to the broader market. That's where beta comes in, right?
Right, beta. Beta measures a stock's sensitivity to systematic risk. That's the risk inherent to the entire market that you can't diversify away.
Yep.
So a beta of 1, it means the stock tends to move, on average, in line with the market. A beta greater than 1 suggests it's more volatile than the overall market, bigger swings up and down. And a beta less than 1 suggests it's less volatile.
So beta tells you about relative volatility.
Yes, but it only tells us about that relative volatility, not necessarily about outperformance compared to the risk taken, right?
Yeah.
For that, we look at alpha.
Exactly. Alpha is a measure of an investment's performance relative to a benchmark index, like the S&P 500, after adjusting for its risk, often using beta.
So positive alpha is good.
Positive alpha indicates that the investment has outperformed its benchmark on a risk-adjusted basis. It's often seen as the value added by active management. Negative alpha indicates underperformance.
Got it. And finally, the goal for many investors. When you sell an asset for more than you originally paid for it, that profit is called capital gain.
Capital gains, that's what many are aiming for.
Okay, now let's briefly touch upon some common trading and investment strategies and tools. We have hedging, arbitrage. What are those?
Okay, hedging is a strategy used to reduce the risk of adverse price movements in an asset you hold. It typically involves taking an offsetting position in a related asset, like buying insurance.
Makes sense? And arbitrage.
Arbitrage is different. It seeks to profit from tiny, temporary price discrepancies for the same asset in different markets. You simultaneously buy low in one market and sell high in another.
Sounds tricky.
It relies on speed and exploiting market inefficiencies, and it's often done by sophisticated players with advanced technology.
Right. And then there's short selling, which, as we kind of touched on with bear markets, is a way to potentially profit from a decline in a stock's price by borrowing shares and selling them, hoping to buy them back cheaper later.
A risky strategy, but part of the market landscape. Now let's talk about margin and leverage.
Investing on margin, that's borrowing money to invest.
Yes, it involves borrowing funds from your brokerage to purchase securities. This can definitely amplify potential gains.
But also losses.
Exactly. It amplifies both potential gains and losses significantly. Leverage is a broader term that just refers to using borrowed capital for any purpose to increase the potential return of an investment. While leverage can magnify profits, it always magnifies risk.
So a more risk-averse strategy would be portfolio diversification.
Absolutely. Diversification is the classic advice. Don't put all your eggs in one basket. It's the practice of spreading your investments across different asset classes, stocks, bonds, real estate, industries, and geographies, to reduce the overall risk of your portfolio. The idea is that different investments won't all move in the same direction at the same time. If one investment performs poorly, others may perform well, offsetting some of the losses.
Okay. Now, when it comes to actually executing trades, buying or selling, there are different types of orders we can place with a broker.
Right. The simplest is probably a market order.
What's that?
A market order instructs your broker to buy or sell a security immediately at the best available current market price. It prioritizes speed of execution over the exact price.
Okay, so you get it done fast. What if you want a specific price?
Then you use a limit order. A limit order allows you to specify the maximum price you're willing to pay when buying or the minimum price you're willing to accept when selling.
So you get more control over price.
Yes, but you sacrifice speed. Your order might not get filled if the market price never reaches your limit price.
Got it. And finally, to help manage downside risk, many traders use stop-loss orders.
Yes, a stop-loss order is an instruction to automatically sell a security if its price falls to a predetermined level, your stop price.
To cut your losses before they get too big.
Exactly. It helps to limit potential losses, though it's not foolproof, especially in very fast-moving markets where the price might gap down below your start price.
Okay, we're covering a lot. Let's quickly define a few specific types of stocks you might encounter. Blue chip, cyclical, and defensive.
Sure. Blue chip stocks, think of the big famous names. They're shares of large, well-established companies with a long history of stable earnings and often reliable dividend payments.
Lower risk, generally.
Generally considered lower-risk investments, yes.
More stable.
Okay.
Cyclical stocks.
Cyclical stocks are those whose performance tends to closely follow the ups and downs of the overall economic cycle.
Like what?
Think of companies in industries like automobiles, airlines, luxury goods, construction. When the economy is booming, they do well. When it tanks, they tend to suffer more.
Right. And defensive stocks.
Defensive stocks are kind of the opposite. They're from companies that provide essential goods or services that people need, regardless of the economic climate.
Like food or medicine.
Exactly. Utilities, consumer staples, food, household products, healthcare. Their performance tends to be more stable and resilient during economic downturns.
Okay, useful distinctions. We're nearing the end of our rather long list. Let's cover just a few other important terms, starting with exchange rates.
Exchange rates. Crucial for the global economy. The exchange rate is simply the value of one currency in relation to another, like dollars to euros or yen to pounds.
And why does that matter for investors?
Well, it's a critical factor in international trade and investment. It affects the cost of imports and exports, the competitiveness of domestic industries, and the value of foreign assets when translated back into your home currency.
Okay. And related to trade, when a country consistently imports more goods and services than it exports, it experiences a trade deficit.
That's right. A trade deficit can have implications for a country's currency value over the long term and its overall economic balance with the rest of the world.
Now, investors closely monitor how individual companies are performing financially, and that's where earnings reports come in.
Yes, earnings reports. These are the quarterly or annual financial statements released by publicly traded companies. They detail revenues, expenses, and, crucially, profits or losses.
And the market reacts strongly to these.
Often, yes. These reports can significantly impact a company's stock price as investors digest the information and compare it to expectations. Surprises, good or bad, can cause big moves.
Okay. On a slightly different note, we have insider trading.
Right. Insider trading involves trading a public company's stock or other securities based on material, non-public information about the company.
And that's illegal.
Absolutely illegal in most places because it gives those with privileged information an unfair advantage over the general public.
Okay. Finally, let's touch on two more concepts: black swan events and the yield curve.
A black swan event sounds dramatic.
It is. It refers to a rare, unpredictable event that comes as a major surprise and has severe consequences for the markets and the economy. Think of major unforeseen crises like the 2008 financial crisis or the initial shock of the pandemic. They're hard to predict but have massive impact.
Right.
And the yield curve.
The yield curve is a bit more technical but very closely watched. It's a graph that plots the yields, interest rates, of bonds having equal credit quality but different maturity dates like 3-month, 2-year, 10-year, 30-year Treasury bonds.
And the shape matters?
The shape of the yield curve is often analyzed as a potential predictor of future economic conditions. Normally, longer-term bonds have higher yields, but an inverted yield curve, where short-term yields are actually higher than long-term yields, has historically sometimes signaled an impending recession.
Wow, okay. That was quite a journey through a vast landscape of economic terms.
It really was.
Hopefully, if you stuck with us, you now have a much clearer understanding of the language used in the financial world. It's less intimidating now, maybe.
Absolutely. And as we've explored these 50 or so terms, you can really see how interconnected they are, can't you?
Yeah, definitely.
For instance, you see central banks lowering interest rates, trying to stimulate growth.
Right.
But that can, if not managed carefully, eventually lead to higher inflation down the road.
Right.
Understanding these interrelationships is really key to interpreting economic news and making more informed decisions.
Our aim today was really just to demystify these concepts, unpack them a bit, and provide you with a solid foundation for navigating the financial landscape without feeling quite so overwhelmed. It's about empowering you to understand the forces at play.
Exactly. And perhaps this raises a compelling question for you, the listener. Consider how just 3 of these terms we discussed, say inflation, interest rates, and consumer confidence, how might they interact in the current economic environment? And what potential implications could those interactions have for your own financial planning maybe in the coming months?
Yeah.
What further questions does this exploration spark for you about the broader economy and, your place within it?
Good thought to end on.
We definitely encourage you to continue your learning journey.